Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hi everyone, this is Shaily Gang, Chief Investment Strategist at Standard Chartered Bank, India. On this podcast, I would like to share a recap of H1 2026 and discuss our outlook for H2 2026. It has been a challenging first half of 2026 for most investors. They have had to navigate numerous odds, the macroeconomic highs and lows, volatile equity markets, and hardening bond yields through most of the H1 2026, all tied to the Middle East conflict and the ensuing energy crisis. The relatively less volatile asset classes such as large caps, bonds, and gold, they also took a hit during this conflict phase. If oil continues to stay near pre-conflict levels, any increase in inflation could be transitory, with markets overlooking it as earnings are expected to remain broad-based. In the near term, the market will remain likely hostage to volatile Middle East developments. We prefer large caps as the base case or in case of re-escalation, while a faster than expected normalization of the situation should support the earnings recovery of small caps. Now in this background, what is changing which is driving our outlook for H2 2026? We remain overweight equities. With oil prices currently receding close to pre-conflict levels, we expect high single-digit to double-digit earnings growth to kick in. The expected earnings upgrade cycle would pave the way for earnings compounding to begin. Within equities, we are overweight large caps as they are better equipped to deal with the aftermath of supply disruptions and the time taken for higher input costs to normalize. Within equities, we are overweight financial services and consumer discretionary sectors. Investment-led in cyclical sectors such as industrials, materials, utilities, and information technology are our core holdings. On the defensives front, healthcare has moved from overweight to core, while consumer staples has moved from overweight to underweight. We continue to remain underweight the energy sector. Bonds offer attractive accrual income. We are overweight short maturity bonds and high quality corporate bonds, with the long end being our core holding. We expect the government security yield curve to steepen, with short end yields coming down, long end yields remaining anchored or falling slightly, and corporate bond spreads compressing. We remain overweight gold, which is our preferred diversifier. Given the soft US labor market and falling inflation expectations, we expect the Fed to hold rates in 2026. Thus, we see limited US dollar upside and limited downside for gold in USD terms from here. The medium-term outlook for gold in USD terms remains supportive, driven by structural buying from the emerging market central banks. Let's delve deeper to see what is turning the corner on macro, equities, bonds, and gold. First up, the macro map. India's macro map is steering well. India's macro narrative shifted from optimism to caution to relief in H1 2026. The growth inflation trade-off worsened somewhat through H1 with slower growth, stickier inflation, and a weaker currency. But falling oil prices post the recent US-Iran interim deal serve as a swing factor that could ease pressure in H2. The balance of payments looks likely to turn from deficit to surplus, and a steadier INR and Apple liquidity surplus gives Indian macros a manageable footing in the near future, mitigating upside risk of inflation and downside risk of growth. Ultimately, monsoon deficit is one major risk to watch out for, and more so, the re-escalation of the Middle East conflict as well. Next on Indian equities and sector discussion. Indian equities are attractive due to expected broad-based earnings. Indian equities had a rough H1 2026 with the large cap heavy Nifty 50 emerging as one of the weakest major global benchmarks in USD terms due to the US-Iran crisis. Large caps lagged on foreign institutional investors selling tied to the geopolitical risk-off sentiment and the semiconductor segment chase in South Korea, Taiwan, and the US. Domestic flow-driven mid-small microcaps held up far better, a sharp reversal of the typical flight to large cap safety pattern. Before we discuss sectors a little in detail, let me bring up the GDP growth discussion here. India's economy closed FY26 on a strong note, with real GDP growth coming in at 7.7%, supported by resilience even in Q4, despite some moderation. Q4 FY26 GDP growth came in a tad lower, but remains robust by historical standards. Services and manufacturing were the principal engines of this expansion, with services growing at a high single digit for the year, aided by sustained momentum in trade, transport, financing and real estate, and manufacturing posting an even stronger double-digit year-on-year growth. Looking ahead to FY27, real GDP growth is expected to be 6.5%. Inflation estimates stand around 5%, and thus nominal GDP is projected to accelerate into double digits to 11 to 12% year-on-year. A high nominal GDP indicates higher prices and thus higher revenues. Tied to the nominal GDP growth rate of 11 to 12% year-on-year, we expect high single-digit to double-digit earnings growth to kick in, with the earnings upgrade cycle paving the way for earnings compounding to begin. A little blip could be expected in Q1 FY27 as input costs have surged. Services are expected to remain the standout performer. The contribution from industry could be weaker as it deals with the aftermath of supply disruptions caused by the Middle East conflict and the time taken for higher input costs to normalize. Once we are past this transition phase and oil continues to trade at pre-conflict levels, and earnings upgrade cycle can come into play and the earnings compounding can start. The tailwinds from earlier tax and rate cuts could taper, but the wider benefits from RBI's recent measures to boost USD capital inflows would kick in. Downside risks to watch are energy prices rising again, a weak monsoon or El Nino patterns, softer real income and slower job creation. Lower oil prices, stronger capital inflows and improved macro stability are cited as potential upside surprises. Let's discuss which sectors look attractive from portfolio positioning perspective. H1 2026 sectoral performance was highly polarized, with defensives and domestic cyclicals leading returns, that is industrials, utilities, healthcare outperformed, while IT and energy emerged as the key laggards. Consumer-focused sectors, financials and staples delivered modestly negative returns, while materials posted a modest 2% gain. Consumer discretionary, we are overweight. The sector. The sector captures the benefit of recent fiscal stimulus, which is tax cuts and GST rationalization, feeding into spending. Consumer discretionary is favored on the back of genuine demand recovery story. Recent income tax cuts and GST reductions are expected to lift retail spending, with airlines, beauty, retail, quick service restaurants, e-commerce, hotels and diagnostics being key beneficiaries of the rising discretionary wallets. Job creation and urbanization are prerequisites for this consumer sector to grow. Autos also remain a key beneficiary of the consumption recovery, supported by India's low vehicle penetration, rising incomes, and improving infrastructure. Within the sector, four-wheelers and commercial vehicles are preferred, reflecting strong premiumization trends and an improving replacement cycle, while EV adoption continues to gain traction, particularly in two-wheelers. EPS growth for consumer discretionary is set to rise sharply from 4% FY24 to 26 to 23% FY26 to 28. Our financial services sector overweight view is anchored by improving credit growth, stable to better net interest margins, and attractive valuations relative to history. We expect a stronger earnings trajectory for banks, benefits flowing through the FCNR deposit raises and margins holding up even as the rate cycle evolves. Select non-banking financial companies are also preferred, helped by a narrowing margin gap versus banks as they benefit from earlier rate cuts, lower credit costs, and cheaper access to bank borrowings, plus bond issuances amid improved system liquidity. The sector is trading below 10-year average PE, with the sector likely to see FY26 to 28 EPS upward revisions as credit growth picks up and earnings downgrade ease. Coming to bonds, we are constructive on the shorter end of the yield curve, long end being our core holding. Bonds had a constructive H1. The RBI kept the repo rate unchanged at 5.25% through multiple meetings after a December 25 cut, maintaining a neutral stance amid a weakening INR and rising bond yields. This occurred even as the Iran crisis threatened growth and stoked inflation risks. Yields were volatile through H1 but trended down, with the 10-year GSEC falling to a multi-week low in June as oil cooled and the RBI announced measures to encourage capital flows alongside growing index inclusion expectations. Talking about rate hike cycle for FY27, the RBI held rates at 5.25% while flagging higher inflation risks from crude oil in the June RBI MPC meeting. What is the expected RBI rate action, with oil prices now retracing back close to pre-conflict levels? The June 2026 RBI MPC was centered around smoothing INR volatility through capital flow enabling measures rather than adjusting interest rates, which helped enhance market confidence and aid in risk premium compression. The risk of a significant rise in policy rates is limited, with growth risks tilted to the downside due to supply chain disruptions and inflation expected to remain within the RBI's tolerance band, despite the rise in consumer and wholesale price inflation driven by higher energy prices. With oil prices receding due to the easing conflict, the RBI will likely adopt a wait-and-watch approach, particularly now. These two developments, namely the RBI's recent measures to boost USD capital inflows and the resumption of energy supplies, these two developments seem to have pushed out expectation of rate hikes further, with the market currently debating whether any hikes will be required at all. RBI measures are expected to bring in USD 60 billion to 80 billion in FY27, enough to move the BOP from a deficit to either neutral or a small surplus, effectively taking the pressure off the INR. The benefits run wider than just the headline BOP number. As US dollars arrive, the RBI buys them and releases INR liquidity, which can lift banking system liquidity above INR 5 trillion to 6 trillion by September 2026. The average net liquidity surplus was approximately INR 1.6 trillion in May 2026 compared to an approximate amount of INR 3.8 trillion in April 2026, driven by the RBI's intervention in forex markets and a rise in currency in circulation. Moreover, foreign currency non-resident bank deposits give banks durable funding at a point where credit growth has run well ahead of deposits. With a falling credit-to-deposit ratio, improving liquidity surplus, and weak credit demand due to the RBI's recent measures, short-term yields are expected to come down and corporate bond spreads are expected to compress. The yield curve has already shifted down, with the 10-year yield dropping to 6.75% levels. Long-end yields are expected to remain anchored given the steep sovereign curve, the fully accessible far route inclusion of new 15, 30, 40-year papers, and government borrowing shifting to lower maturities. Far-tagged securities are those government securities which FPIs can buy without investment ceilings. a favorable risk reward is seen in long end bonds and SDLs given the steep sovereign curve and attractive yields on offer. Gold. Through a near and long term lens both, gold was volatile in H1 2026 but remained a strong performer in INR terms, rising approximately 6.2% YTD despite USD gold declining by approximately 7%. This divergence was largely driven by almost 5% depreciation in the INR against the USD and higher gold import duties, both of which aided domestic gold prices. Gold reached record highs before a sharp correction, but investment demand remained resilient and its sensitivity to traditional macro drivers, particularly real yields and the USD, has re-emerged. The long-term gaze for gold remains intact, although the drivers of the rally are becoming more balanced, while elevated real yields and a firm USD could moderate near-term gains and result in intermittent profit-taking. Sustained central bank purchases, ongoing reserve diversification, and residual geopolitical risks should continue to provide structural support. Gold also remains an attractive portfolio hedge, while a prolonged Fed pause is likely to limit USD upside and support prices. These are challenging times, but these are times to build portfolios based on attractive segments and pockets across asset classes, adding hedges and diversifiers. See you soon in the next episode. Until then, take care and happy investing.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.